And if you do prefer to watch it in Discord, you can. I'll stream it on there too. So we'll go ahead and get started here. So this is going to be on trade management. I tried to keep it a little bit shorter than usual as well to try and pack as much information into a short period of time as possible. So let's see here. There's the disclaimer. So what we're going to talk about today is scaling in and managing your average price and how we manage and set stops effectively. Going over some of the patterns that we use frequently as well for some of the new members that maybe might not be familiar with them, because we do spot, these ones that we're going to go over quite frequently. So you want to be familiar with them. And Friday market recap as well. We're going to go over exactly what happened on Friday. I know I wasn't there on Friday, but we're going to go over exactly what happened to the market and what some of the plays could have been there. So, what is scaling into a position? Scaling into a position is the act of entering your trade using multiple different entries to develop a better average. Scaling in means to set a target price, then enter your trade in volumes as the security or stock moves farther away from your average price. And I'll explain this in a second here. The scaling in continues until the price changes direction or the intended trade size is reached. Scaling in could reduce risk as you have the ability to actively manage your average price. So we're going to actually go over the process of what it would look like to scale in very basically and what that would actually do for you in your trade and why we would want to do that ever. And then how we would manage that trade with stops and actively secure more profit as the trade goes on. So, uh, scaling into a position basically means you're just buying at different levels to ensure that you get a better average price rather than just buying in at one level and perhaps it dips far lower and you don't have the capital to buy any more. You could see how that would be uh, a worse off situation than actually buying in at different levels and perhaps not putting it all in at once and giving yourself the opportunity to scale in, and that's what we're going to talk about here. So scaling an example. And so, for instance, we see a chart, and we might find out an opportunity on that chart to draw some sort of technical pattern or analysis, like these Fibonacci retracement levels. These are actually harmonic Fibonacci retracement levels. We're actually going to go into this pattern if you're unfamiliar with it in a moment. But regardless, the pattern in this explanation isn't really what we're looking at. It's how we trade it. So the basic concept that you need to understand here is that we've identified a pattern that is basically telling us that there's going to be a reversal eventually. So with this pattern, we've actually spotted it a little bit early, and we can see this is an ABCD pattern, and it's measured by using the Fibonacci retracements from B to C. So we've basically drawn a harmonic Fibonacci retracement from B to C on that. So uh, the next step would be it dips down a little bit into the formation of the pattern. Generally speaking, this D point is where the pattern is supposed to reverse, but it's actually a range. So it can start to reverse at the 127, the 141, or the 161. It's somewhere in between that range, depending on the parameters of this pattern. But obviously, you would always want to get the lowest price possible, and if it was to play out to that 161, generally it's a higher probability. So let's say, for instance, you're starting out small and you see that it's hit the 127 on a nice plunge down, and you buy one contract, and then a moment later, it dips down a little bit more to let's see to the next one, and you buy another contract, but you're still targeting that 161 because you may want to buy even more there. But the question is why did we even buy another one here? Like, it's already come against us, it's already fallen into another level, or why did we even buy that there in the first place? And this pattern, as I said, it can bounce off that 127. So perhaps if you were able to scale in with a small position in aspirations of this whole trend changing and you getting exposure to the upswing in the potential that this pattern is potentially going to give us, um, you may want to start, small, and instead of going 5 contracts here, you might want to just get one. If it moves against you, and it's getting closer to your perfect profit, like perfect trade zone at the D point where the 161 level is here, that's exactly where you would desire it to go in order to um, develop a really good position. But because all of their signals are signaling that it wants to go up at from this pattern, and it may not even get to that 161, so you buy another contract here. And what that does is it actually cuts your average price in half. So you can see at this first line here, I guess we got in at 2055, and then the next purchase was in at 1788. So basically, we're right in the middle now, because we purchased 2 contracts, we our average price is spot on in the middle of exactly where we've done that. Because when you buy one contract and you add one contract to it, it cuts your average price in half, and it means you only have to have it go half as much now before you're in profit again. So that can be beneficial because you are taking on more risk, because if it continues dropping more, then you have an even larger position. You have more exposure to it going down. And if if you're incorrect about the pattern and the reversal, that could be an issue. So let's say, for instance, we've identified this pattern. It's supposed to reverse at the 161. If it goes any farther beneath that, this pattern is no longer existent. But our profit target is well beyond the C point, or at least the C point. So we know that if we start buying in this area, our losses will definitely not outweigh our potential gains, because we we regardless have a lot more to the upside than we do the downside in this trade. And for instance, if you were uncomfortable with even having a larger position in the first place, maybe you wouldn't have taken the first contract at the 127. Maybe you would have just waited for the 141, or even less riskier, you could wait for the 161. But that might mean that you might risk missing the trade. But sometimes that's okay, because there's a million of these patterns every single day. So um, I hope everyone's following along there. If you have any questions, please let me know as well. But so let's say, for instance, we're in that same situation, and it's started to pop up above our average here. One of the next things that we immediately look to do once it starts to run is get a stop loss in profit. You might hear this a lot in the chat, and it's very common strategy in order to protect your gains. And there's a certain way that you can actually do this, because if you were going to see, uh, once we've established a a support and then ran off of that support, the next thing that we do is we put a stop loss to protect our gains just beneath that support. And we can see, as it rallied up, it made another support level. What we can do is drag that stop loss and a profit up and secure our gains at that level now. So that means that no matter where this trade goes, if it has a huge red candle and just spikes down, we're going to be safe as we have a stop and a profit there, um, especially if you're trading futures. Uh, let's see here. So as it moves even higher, you can decide to take some of your position off and move your stop loss up in a profit. But basically, this takes the emotion out of the trade, because you understand that your profits are secured, and uh, you can actually let that trade run even more. So let's see here.
Hey John, sorry to interrupt.
Hmm.
You just got a quick question there. I'm sure you're
Yeah,
about
what's
to
up?
go into it with the harmonics, but someone's wondering how you got the 161, which would be the extension
Oh, yes, of
USD.
course. Let me
Can you show
actually just
that?
show you here. Let me show you. Uh, whoops. I believe that was on oil. This now, I don't usually trade oil too much, but not lately because of the recent volatility. BCO USD, just double checking. And I believe it was on the hourly chart. Here we go. Perfect. So I got the 161 level by doing this. So basically what you would want to do is you would want to select your Fibonacci retracement level, uh, which on TradingView is here. And there's any platform generally should have their Fibonacci retracement. But once you've selected that, I like to zoom in to the B point here, start my fibs there, and then drag them all the way up to the C point. And generally speaking, that's where, whoops, that's where we get uh, our D point. And in this case, we can see the 141 was the actual uh, one that held. And this is relatively recent movement as it is on the hourly though. So uh, we can still see the effectiveness of it. And also, this pattern can be applied on any time frame, just as any other technical pattern as well, mostly. But yeah, from the B to the C point. What I like to do as well, so if you want to take a look, these are my Fibonacci levels, and they're actually modified a little bit so that there aren't any left out. So these are one of my templates that I have, and they're all fibs. Oh, sorry, all fibs. Let me just remove that for you. And then I'll just show you quickly how I can remove some of the confusion, I guess you could say, from this. So let's remove that real quick and go back to my fib set here. I like to use my harmonic fibs, and that basically takes off any level that isn't going to be used in finding the D point of any harmonic pattern. So I'll just quickly show you and you can see it obviously removes a lot of the clutter and then focuses in on this is the level for our D point reversal. So these are I'll just put it in the chat for you so you can look at them. But yeah, perfect. So as we can see, and I'll just get back to this here as well. And let me know if you have any other questions too, though. But let's see here. So stop loss and profit, as we can see, it continues to ride up, and you can and emotionlessly ride this trade as it continues to make new highs. And with your one uh, goal of every single time it establishes support, you raise your stop loss up even higher, protecting your trade against any potential downfalls and securing your profits. So that's a major concept. I just wanted to get out there and make sure that it was ultimately very clear because this is what we mean by stop loss and profit. It means you've purchased here lower, and you're putting your stop loss in above your average price, where if it was to sell you out, it would be profitable basically. So we want to talk about rising wedges and falling wedges just for everyone that is brand new as well. And these are very common patterns and very effective patterns as well. So I just wanted to go over. This is the most recent one that I found in the chat, and it was work. Work is a rising wedge right now, so I would definitely watch out for that in the intermediate term. Yo, Jacoby, you're open mic. But work ended up playing out of its rising wedge like such, and it also basically in this case it had a Fibonacci extension that I've drawn on there, but for the purposes of this rising wedge, it's irrelevant. So what we want to talk about is how these two trend lines, these two significant trend lines, the one that was supporting the trend, this all of the candles on the way up here. And then we have another very important trend line that was used as support, retested as resistance, and then used as resistance again at a very significant 61.8 extension level. And then in the future, we came up to hit this again at a 113 extension level. And as the support and resistance closed in on each other and uh, and they got closer to each other, and basically that tighter volatility at such an incline causes the stock to reverse generally. But the most important part of a rising wedge is the support line, because the support line is the deciding factor of whether or not it changes trends. Sometimes if you see a falling wedge and only got half of the wedge completed and it falls out of that falling wedge, generally what you'll get is a retest of that falling wedge because they like to fall out of the tip of the rising wedge. Even if they've fallen out before a little bit, sometimes they'll make their way back up and have that retest of one of these lines. So that's really important. Uh, but this is another gold rising wedge coming out of the chat. I'll show you in more detail here. So this was the picture of the rising wedge, and basically we can see that it's uh, using longer term resistance. This is on the 1 minute as well, by the way. So the work one was on the daily chart. So it goes to show that this pattern is effective on multiple time frames. Uh, but as we can see, it was high of touching the highs on the uptrend that it had there, and then the lows were also connecting closer and closer to the high, and the volatility was tightening as it got closer to the tip. And you can see even in this one, because it didn't quite get to the tip of the rising wedge, it spiked down as soon as it broke the uptrend, which is a very common uh, characteristic. And then what it did was is that actually came back up for a quick retest of that bottom line. Now this is the retest I was mentioning about a moment ago. And then generally after that retest, you get a continuation. And you can see we actually caught the falling wedge at the end of this downtrend, which was a great area for a reversal, believe it or not. Or not. And we actually take a lot of reversals on a daily basis, especially ones that lead so clearly into other patterns, such as this one. But as we can see, that rising wedge completely changed the trend, and it ultimately ended up tanking. And this is another view of it. So we had our rising wedge up there at the top left. It completely destroyed this. This is gold, by the way, and this is a couple days ago. We were trading this. What was that? A couple days ago, yeah. And another rising wedge, perfect example here as well. So we can see on this rising wedge, which I'm going to pull up on an actual chart here, and we can just quickly go over it. I just want to show you what happened here. So let's take a look at the 1 minute. So we have the 1 minute chart here, just as some perspective. There's our rising wedge. Oh, and here's another rising wedge too. If you want to take a better look at that, we can see, we had a strong support line, came down, retested the rising wedge, and then continued for a short period of time. But still, that's phenomenal on the 1 minute as far as uh, gains, potential gains for a futures contract goes. Um, yeah, $6 there. But anyways, let's take a look at our old rising wedge that we were just looking at in the chat. So this was the rising wedge that played out into a falling wedge. And as we scroll past, we can see that there's yet another rising wedge here. Now this one is a little bit more interesting because we can see we have a strong resistance line here with our strong support line, which once made a rising wedge, and then you can see it had a prolonged retest, which ultimately made another rising wedge that played out. So we can see it actually tried to retest one of these long-term resistance lines, and that's a very you know high probability area when it is at such a height over all of its moving averages, and you can tell that it's above the mean. Basically, there it would have been a high consideration for a short at these levels, as we can see that of their importance was high when they were used in the past. So trades like that, once you do take a rising wedge, immediately what you want to do actually is you want to apply your Fibonacci's. And if you're unfamiliar with Fibonacci's, I'll just quickly apply them on here. So um, sorry. So as we can see, those are the harmonic ones. I'll have to just change those back to my other fibs. And as we can see, once, because some people might be like, okay, once you take your position in the rising wedge, how do you know where you're supposed to get out? Well, that's a great question. So we have Fibonacci's applied from the low of the trend to the high of the trend of the rising wedge. And basically these give us great support and resistance levels to work with as the stock tanks down. As we can see here, it got all the way down to the 241% retracement level. Um, Phenomenal trade there, but let's see. For trend lines, is it best to go off the tip or the wicks? So that's a good question. It depends as well. So if you see that the wick is actually, a very significant uh, support level that's been used many other times. Like let's say it comes from, let's see here. Let's say it comes from a trend line that's been used like multiple times. Sorry, that's not the best one. Let's check this one out. Let's see if there is one up here. Yeah, let's say for instance it's that trend line, and we can see we've got a predominant high here, and it was retested twice, and then it was rejected, and then once broken, it ran, and then all of a sudden it comes back down to retest it with precision. Uh, generally speaking, you can say that this is the beginning of the uptrend. So generally speaking, what you want to do when you're doing Fibonacci retracements is you want to actually start from the beginning of the move to the end of the move. Now, not always is it the low to the high, but generally speaking, if you are confused at which ones you should do, uh, it's okay to put both of them on and see which ones will respond the most. And you'd actually be surprised to see that generally you'll get a great response out of let's see here. Sorry about that. You get a great response out of the lows to the highs of any predominant move, as well as it works in reverse as well. If you're unfamiliar with them, like you can analyze uptrends and downtrends with Fibonacci's. But as we can see, you can apply from the lows to the highs, and obviously, like I wouldn't be surprised to see this high here as a Fibonacci from the high to the low. Like uh, we could always apply those as well, just so you can get an understanding. Like these are all correct. Like they can get cluttery. There's things that you can do to increase the visibility of certain ones. Oops. So if we take a look at the thickness of the lines, so we know that this is a larger picture Fibonacci range. And now that when we are actually analyzing it, we can see the thicker lines come from bigger picture analysis. But generally speaking, you can put them all on there, but if you're trading in a very short time frame, such as the 1 minute, generally I like to have them on there because you can see we barely have any in our range here. Like if we do run into them, I generally would want to know about any of those Fibonacci levels. Let's see here. I'm not sure about how to add extra fibs on Thinkorswim, but we can definitely find somebody that uh, would be able to help you with that too. There. Let's see. So we're going to briefly go into harmonic patterns because, we've talked about fibs and everything today, and I think that it's actually great that we're going to go into a couple of these. I'm not going to go into every single one, but I actually want you guys to be familiar with some of them and understand exactly what we're talking about when we're talking about them in the chat. So ABCD harmonic patterns, these are the basic harmonic patterns. You might see us talking about other ones that look like M's and W's. We're going to get into those in a moment, but these are an advanced way to look at a pattern that you might know as a bull flag or a bear flag. Like you might be looking at this and being like, oh, that's a bear flag, or this is a bull flag, right? And you're right. You know, they do respond as those patterns, but there's a more technical way to actually look into them. So they consist of three price moves and 4 points. So what they mean by that is you've got one move up, one move down, and then another move up in this case. So that's three moves. So you've got A to B, which is one move, B to C, which is another move, and then C to D, which is your third move. And your 4 points. You've got your A, B, C, D. So 4 points, three moves, and it basically it means that a reversal will occur as a result. So in this instance, this is a bearish ABCD harmonic pattern, and in this case, it's a bullish ABCD harmonic pattern. If it's pointing down, it's supposed to reverse up, and if it's pointing up, it's supposed to reverse down. So there's three different types of them as well here. I'm just going to go into them as well. So you've got your classic ABCD pattern, which basically a lot of them look very similar. We're going to go into a couple of them here though. So the classic ABCD pattern is the C point should be at the 61 to the 78 retracement of the A to the B. So basically, if you take a Fibonacci retracement from A to B, the C point should always be from the 61 to the 78. So like this is a harmonic pattern. They're called harmonic patterns because this pattern works in harmony with Fibonacci levels. Now it's one to be used with precision generally as well, and you can accurately predict each and every single level many times with harmonics, and especially if you get familiar with them, they can be an invaluable tool. So let's see. So you would use a Fibonacci retracement tool from the A to the B point, and the C point should be close to the 61 basically. It should be a 61 to the 78. The D point in its turn should be at the 127 to the 161% of BC. So basically, if you draw a Fibonacci from B to C, that should give you your 127 or 161 fib, and that's why we want to use these. Um, we want to use these. Let me just find a blank space here. We want to use these special Fibonacci retracement. Sorry, tools. So this is the ABCD pattern. Just like any other pattern, you would just highlight it. We've got ABCD basically like that. So um, what this is telling us is we should initially have a move down, which will be our move down like this. And our B and our, yeah, sorry, this will be our A point, and this will be our B point. Our C point should be somewhere in here. It should be somewhere between the 61 and the 78. So we have our next move up there, and then we draw our next Fibonacci. Let's say it ends exactly at the 74 in this case. So we would draw our Fibonacci's, but at this time I would select my harmonic ones. Like you don't actually have to. It's just a little bit more messier if you do it like this. Like you can see all the ones in between. So I'm going to show you without the level. So if we were to go from the B to the C point, we're going for these Fibonacci's down here for our potential D point. And then where does it bounce from? It generally bounces to one of the other points. So you want to have a very close watch on the B point. So when it bounces from the D to the B point, generally speaking, it's met with very heavy selling pressure. But then we can see that it actually bounces to the C point. Now let's take a look here, and just to clarify one of these patterns that we went over earlier, just to see if you can see how it would work there. So we've got our A, B, C, D pattern reversed at the 141. You could have started scaling in at the 127 with your ultimate eyes on that 161, blasted up and completely reverse the trend. So that is that pattern. And if you have any questions on that, definitely let me know. But generally, like as they're saying here, the take profit is roughly at the B point. If you and it's not very far at all. Like generally speaking, it's met with extremely heavy selling pressure or reversal pressure in whichever direction it is facing. It's generally that B point is where you want to focus on. Um, let's take a look
And
here. Yep.
John, for those that don't know or maybe confused,
hmm
you absolutely can use harmonics on any time frame.
Of course, yeah. Of course. Now, I just wanted to quickly go over this one here too, because it says that, as I said, there's three different types of ABCD harmonic patterns, and I didn't want to go into like too many things here, but I find it very interesting, so I'm going to go over it anyways. The the AB equals CD pattern. Now, this is really interesting because it actually incorporates the time. So you can see from our A to our B point should be the exact same distance from our C to our D point. Now I'll just remove this so that box just disappears. But if you take a look at where we were just looking in the middle chart there, from our A to our B point should be the exact same time from our C to our D point. Now, one cool way that you can actually measure this, and I just want to quickly show you, is you can actually use a rectangle to do that. So, for instance, if you take a rectangle, let me just stop that for a second there. So I take a rectangle from our A to our B point, and if I just copy it and paste it again real quick, which is like Control C, Control V, and then you just quickly do that. Now, is that not amazing how it exactly reversed at the same distance? Like if anybody's unfamiliar with what just happened there, I literally pasted the same box. This is the exact same box as this one. Exactly the same. Now I drag it over here and look at how it exactly bounced off of the low of that box. I don't know if it's clear or not here. Let me just zoom in. But yeah, the from the A to the B point, the same distance equals the C to the D point here. So we've measured. Let's take a look at that as a matter of fact here. Same distance. Whoops. We can measure the distance from the A to the B point, which is 1750. And we'll take that same measurement, 1750, 1749.5. So very, very accurate pattern. If anybody doesn't understand this, let me know. So the same distance from the A to the B point, and the same distance from the C to the D point, these rectangles are magic. And ABCD extension. So uh, the extensions can obviously be used as well. Let's take a look here. I'm not going to expect this one to respond too well to extensions, but I'm going to show you how you would draw it because it would make sense here. So let's take a look here. We've got our extension tool. We start at the A point, drag her down to the B point, and then all the way to the C. 100% extension level exactly on the bottom point. So if that doesn't want to be, if like I don't know how much more accurate you want this pattern to be here. For instance, the extensions in them in their own will dictate that 100% of the move is completed at this level. So in my opinion, I think that's a very important level. And in this case, it was completed at 100%. Sometimes you can get a lot more of the move. As you can see, there's a lot more extensions. But generally speaking, that 100% level is very, very important to a lot of traders. And in this case, it didn't play out to the 161 like it would usually. Like, hold on a sec. I want to actually The 161 would be all the way down here. But anyways, extensions can go on a little bit more, as there is three different types of these patterns. But if you're unfamiliar with the extensions, we drew from A to B to C to get our extensions that are plotted in dotted lines here as well. If you have any questions on that, definitely let me know. But that's our ABCD patterns. I just wanted to quickly go over those uh, as well. Yeah, so butterfly harmonic pattern. This is what it is in the back there. You might have seen them as M's and W's and everything like that, but this is a little bit more of an advanced way to look at them, and it's actually very simple once you uh, get the parameters down. And if you could just draw them or write them down next to your computer or something like that, and you can really take advantage of them. So the butterfly is a reversal chart pattern that falls within the category of harmonic patterns. The pattern represents the price consolidation and is often seen at the end of an extended price move. We haven't talked about Elliott waves today, but we can definitely talk about it in the future, and we have a class on them as well. But in Elliott wave terms, you will often see this pattern during the last wave, the wave 5 of an impulse sequence. If you check out our last class, the Jack of all trades class, we went over brief impulse waves as well. And you'll also notice how a corrective wave is very similar to an ABCD pattern, but an ABCD pattern is a more advanced way of looking at it. So you guys are ahead of those Elliott wavists. Anyways, um, structure of the butterfly formation. The butterfly pattern has four price swings. So basically, one price swing from X to A, and then A to B, and then B to C, and then C to D. So you got one, two, three, four to form the M or W, I guess you could say. So remember, the M in a downtrend can signal a reversal to the upside, and a W in the uptrend can signal a reversal to the downside. So that's very basic way to look at it. So always when it does have a W-like shape to it, regardless of what type of harmonic pattern is, because there's five or six different types of harmonic patterns. And I even think that we've found another one which we can go into another day. But in this case, this has precise parameters that are meant to play out exactly the same way every single time that this pattern is found. Now, uh, during its development, it can sometimes be mistaken for a double top or a double bottom. So that's another really novice way of looking at this pattern, is just to say, hey, price came up and then it went down and then up again and made a double top, or it made a double bottom, and that double bottom rallied up. But it's like you can actually do something when you see that now. Like there's actually a play with that, and I'll show you what it is. So there's as exact parameters with this, just as there was an ABCD pattern, except this is an XABCD pattern. So there's an extra um, leg in there. So from the A to the B point, it is basically a 78% retracement of the X to the A leg. So as you can see here on this picture below, here I'll quickly show you guys this as well. So you can see that it says 78.6 here clearly, right? So from the X to the A point, the distance is the 78.6. And just as we can see here, the B to the C move should either take a 38.2 or an 88.6 retracement from the A to the B move. So we can see here it's depicted as 38.2 or an 88.6. So that would mean from the A to the B point, we have to have a 38.2 or 88.6 retracement, just as it's gonna dictate a 161 or 261 to get our D leg. So we would obviously take a fib from the B to the C. It would have to be a 161 or 261 point to get our D leg. And basically that is one of the most commonly used harmonic patterns. If you are interested in these, we have a very in-depth class on harmonic patterns. This is actually out of that as well, so you can check out the rest of them. We have a really in-depth video on that as well, so feel free to check that out. And I just wanted to quickly go over Friday with you guys. I know the market's about to open, but we're going to have enough time here, I think, to get through going over exactly what happened on Friday and maybe what could have been done as I wasn't there. Excuse all the lines on that. So as we can see, Thursday was really, really quite good. Here's the analysis from what we were actually doing on Thursday. It might look a little jumbled on there, I'm sure, but you can actually see we were attempting to go for an XABCD pattern there as well. And look, it kind of faked out back to the C point, but guess where it ended? Exactly at this point at which, it was intended to change the trend. So there was a huge trade there, and this level was definitely on watch due to the fact that it had such strong support and so on. But regardless, we can see it rallied up and then we caught a rising wedge and shorted it again. But yeah, let's
And
see
this is
here.
Thursday that we're going over here, John.
Yeah, that was Thursday. I'm just trying to find. We actually went over this with Fathom yesterday, so we were drawing
Right.
some other levels on there. Let me just remove all these here, and I'm just going to remove the indicators, clean it up a little bit there. So if we can take a look as well, one major thing that we could have used going into the day would have been this data from the previous trend that we had. So obviously every single line that happened on Thursday essentially was not in play for the next day, which is fine. We do have some longer term resistance lines that were in play as well that we can actually show you here. So if you're curious as to see like where those yellow lines came from, those are exactly where you want to be looking. Obviously, everything else is on short term, but just to get some perspective for the imminent talk, we're gonna just notice that this rising wedge that is formed on the daily for the Nasdaq index. We're watching these lines basically. So let's take a look back at the 1 minute here. So 1 minute. Oh, sorry, 1 minute. Okay, gotcha. And what we have here is our previous consolidation. One thing that we can see that happened is in the morning it started relatively low. There was a spike down, and it was actually a retest from an old broken trend here. So we can see that as this small downtrend broke, it was actually retested, and then it actually met it again in the future, which looks to be the cause of the rally there. And one thing that we definitely would want to do whenever we're trading is connecting all of the lows so that we can actively see when any uptrends are in jeopardy and what exactly can happen. So just a brief example of what can happen when a trend line breaks. So when a trend line breaks, a new trend starts, and it doesn't always have to be in the opposite direction. So in this case, and this is rare actually, it is quite rare, that when an uptrend breaks, it actually can go sideways. And a sideways trend is totally a trend as well. It's a sideways channel. It doesn't always have to go exactly from an uptrend into a downtrend. So there's things that you can do to actually prepare against those uh, situations. Like when we know that the market is clearly bullish and it's running up in a fashion of stair stepping motions or bull flagging or making ABCD patterns or however you want to look at it. Um, there are going to be contrarian trends there for when the market gets too overextended and comes back down and meets its resistance before having enough momentum to continue upwards. But generally speaking, what you want to do in uh, these these periods of strong pumping and and strong trends is you actually want to manage your stop into a profit as quick as possible on every single trade until you find that exact high that you were looking for. Like for instance here, if you're comfortable with taking each one of these highs short and then, developing a position where you can get your stop in profit on every single one of these downswings and until it actually, starts to tank, that's how we actually captured the majority of this move here. Like I managed to drag my stop down all the way down to this resistance level here before getting stopped out on this push up. So if you short here, and for instance, this is actually what we did on Thursday. We shorted at the highs and we shorted this first rising wedge too, and then took profit on the way down, shorted it again at the highs, and then as it came down, we continuously put our stop in profit, dragged it down, and then as it came up, we put our stop in profit again here, and then look, it came back up, didn't stop us out, and then continues down, and then stop in profit beneath the resistance here, I mean support here, and then it tanks down again. Get your stop in profit one more time, and then you do it again. And then finally, if you have anything left by that point, it will stop you out on the final move. But what we actually did, instead of actually simply just moving our stops down, we shorted these highs and then traded the US, the Russell, oh sorry, the Russell, the Russell 2000, sorry about that. We traded the Russell 2000 on every single bump up that it had on that day, as well as these other trades that are in there too. Well, we're very, very, uh, let's say, active during the day. So we like to what we say is develop a core position short. So what I like to do is short at a high probability entry where it's a overextension from the mean and it's a pattern like a rising wedge, which is a strong reversal pattern. Like look at these rising wedges, they're absolutely amazing. They have 100% retracements. What more could you ask for realistically on a rising wedge? But and you can see that they just continuously keep forming these amazing rising wedges. And it's like you got your falling wedges here too. And if anybody can spot the ABCD pattern, uh, which is also apparent there, you know, within a falling wedge. So if all these things are kind of coming together, that's great there. But this is basically what we use to hedge against the Nasdaq. So if for instance we have a core position short in the Nasdaq, which would be let's get them both open here. So we got our Nasdaq open there. Yeah, and basically as the yeah, and basically what we would do is find a core position short in one of the major indexes, and as that was falling down, we could hedge that by going long on another major index such as the Dow at the B point of a pattern and maintaining our Nasdaq short at a higher level, while instead of selling our position out and potentially not capturing that large gain, what we could do is hedge it with another uh, contract. Um,
And John, just for those that don't know, what's hedging?
right, right. So that is when you protect yourself against uh, potential losses by taking a position that could basically save you against losses or protect you against losses. So, for instance, if uh, if you have a long-term position in Apple and you have like 80% of your account in Apple, right? And it's you've had it for 10 years and for instance it's at all-time high and you're like Apple is in is in big trouble, right? And all of a sudden, you think that it might come down. So, but because of 80, you have 80% of your position in that, and you are worried that it might drop, and you don't want to sell it because you want to hold it for another 10 years. So what you could do is you could buy like a put option for like $1,000 or like $500 and secure your trade for that short period of time to the downside with higher leverage. Um, and that would basically give you exposure to the downside for that short period of time. That means that if it was to tank off, you would have protection against your 80% of your position because you'd be leveraged to the downside as well. It's a complicated uh, concept, but basically you're buying something like an insurance policy to protect your overall position. And it's you're taking a trade against your trade that is going to be a short-term trade just to basically buffer it against any potential losses. Um, eh, and if you have any questions about that, please let me know. It is I could have probably done a better job at explaining it, but I'll find you something that you can read on that if you're more interested as well. But those are the main concepts that I really wanted to go over today. We
So
have,
John, can
yep,
you see like Russell where it's gonna go or where you think? Because it had a big spike on Friday.
yeah, sure. Let's
And
see.
there was a question regarding the lesson there in chat, John. I told him to wait till the end.
Oh yeah, no, 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 of course. I don't even mind if you guys come in and ask me. But let me see. What's the question here?
So it was when you were looking at the ABCD patterns.
Right.
He wasn't seeing the rectangles. So maybe if you went over that again.
Oh yeah, yeah, of course. Which one were we looking at that on? Here we go. So, whoops. Um, so we have BCO, which is our oil. This is British crude oil, Brent crude oil. And so one major thing that we can do here is we can see we've got our ABCD pattern. We've got our rectangle, which you can easily get from, if you're on TradingView, it'll look like a brush originally, I'm pretty sure. And then you want to go over to rectangle, grab your magnet tool, because this gives you um, an accurate uh, what would I say? It gives you an accurate, precise point at which you can click. And sometimes it's too precise. Like I have to
Okay. So
actually
he
manage it.
says he didn't see the CD line extend to be as long as the AB line, and that he felt a little lost.
So yeah, yeah. So like take a look here. So the A to the B point. So we copy that rectangle and then go ahead and paste it again. So we can see that that same rectangle is there. It's exactly the same size. Like I can put it within itself again. And we go drag it down to the C to the D point here. So we can see our C, technically it ended here, so that is our D point. And our projections, or the projection for this pattern is for it to reverse at the 127 to this 161. It can be anywhere in between here that this pattern reverses. But in this case, it's actually phenomenal because we have an opportunity to use the 100% extension level, which is, I'll quickly draw that one for you again here too. So we would take our extension tool, Fibonacci extensions. We go from A all the way down to B, whoops, all the way down to B, and then take our C point. And you can see that'll give us extensions. And look at how exactly on point that is, 100%. The 100% level is at the D point. And it's also the exact measurement fr from the A to the B, which is 17. And then we've got, oh, I can't stand it when it does this to me. I can't get the wick. There we go. And then we've got all the way down to the bottom, 17.1. So it's pretty much like I'm gonna give it a break there and say it's pretty darn close. Like the human eye can't tell the difference in my opinion. So we've got the exact same difference. Yeah, no, no, no. Maybe it was just a computer glitch or something. It's pretty Pretty precise there from what I can see. Perhaps we can look at the other one that we were looking at. I think it was on this. There was another one though, I believe. Yeah, there's one here, and let's take a look at this one. I can see that this is clearly an ABCD pattern of some sort. So let's take that same pattern, copy, paste. As we can see, we've got the same rectangle here. This case, it had a slight spike down, but ultimately that would have been an opportunity to add to the position um, in this case. But we can see it. Look at where it stopped at the C point, right? So it technically played out properly. Let's see here. Let's get an extension from X to the A to the, yeah. So we've got a 113 extension that seems to have been in play. The 100% extension, it had a spike bottom, and this is actually a stop killer. And basically, because everyone's stops got hit, price reverted back up to the mean and went even higher actually and exploded. But let's see if there's another one that we're looking at. Perhaps it was on here. Yeah, here. So, this is interesting. So, I think this is the one you were talking about. So, when you look at this one here, right? So, we've got a forecast. So, like before, it was like here, right? And I was literally drawing this pattern out, and it was like we could only see like this much information at the time. And because we had this much information, we could assume that because we had the A, B, C point and it was trying to make a D point, I was like, okay, so what we're gonna do is we're gonna slap the rectangles from the A to the B onto the C to the D here, and that's what I did. So roughly, we had those. I actually had the Fibonacci's on there as well, but I removed them due to clutter. uh, and as we can see, we roughly have a 261 extension. That's where I got our D point. And what else do we have? No, that's good. And then, so we can see it plays out, right? And then, that falling wedge plays out. I believe we took that as well. And, hits the resistance, comes down. Another falling wedge doesn't play out very well because of bad momentum. We can see it. Okay, yeah, this is where I wanted to show you. So we can see that that same level, though, that we were looking at was actually, oops, that same level just extended, or you know what, better yet, I could even just do it this way. Copy, paste, just to be more precise. You know what I mean? So that same level literally was the level we were going for, which was that 241 retracement of your area. The pattern dictates that it should reverse somewhere within these lines, and it sure did.
Market's over green there, John, just to let you know.
Cool, right on. And this is what the market is doing, ladies and gentlemen. Russell 2000 popped up. The Dow popped up, and the SPY, and the NASDAQ. But if you do have any questions regarding anything that we went over today or anything like that, I'd be happy to assist. But if not, really happy to have you guys here, and let's smash it out tonight. I think I might go into the trading floor a little later, maybe for the British Open, maybe, or something like that. But yeah, no, if you have any questions, please let me know, and yeah,